Andrei ascended the levels of the corporate world at a Fortune 500 company, subsequently attaining the position of vice president and then corporate officer, all while thriving as a successful small business owner and real estate investor. Andrei was compelled to help others following several sudden and untimely losses of family members suffered by his employees. He devoted himself to the meticulous study of tax planning and income distribution with an unwavering commitment to assist individuals in accomplishing their financial planning and investment objectives. His expertise culminated in the establishment of Hall Wealth Management. Andrei is an Ed Slott Master Elite Advisor. This is a small group comprised of individuals who are devoted to solving the world's most complex retirement issues. Andrei has a deep understanding of financial markets and is skilled in financial planning and risk management, often sharing insights that help others make informed decisions. His expertise is evident through his successful advisory career. Andrei has been featured on LA radio, podcasts, major publications, and in an Amazon best-selling book. I could go on all night about his accolades. You'll have more questions about RSU and RSA options. Andrei will be the individual to speak to have your questions answered or to meet with about how to manage your restricted stock options. Now, to kick off the night, let's see how we may help you potentially save a couple million during retirement. It's my honor to introduce you to Andrei Hall.
Good evening, everyone. Anthony, thank you very much for that kind introduction. You always like getting introduced that way because you hear such great things about yourself, but at the same time, you know, wow, I'm not that good. But Anthony, again, thank you for the introduction. But folks, let me say very clearly, though, that I have a unique understanding when it comes to restricted stock units, restricted stock awards, stock options, deferred compensation, because I had all of those, I experienced all of those when I was in the corporate world. I was in the corporate world for over 20 years, and I've been doing this for over 20 years. Very few people have had the background that I have that are doing financial advisory, financial planning, money management, etc. I have a unique understanding that most people do not have because I've experienced it real world, and I'm helping people through those pieces right now. So let's move on to restricted stock units and restricted stock awards. What are they? Okay. But what they are is just a promise from your employer to give you stock. You don't pay for them like you do for options. You pay for options, but you do have to wait for them to vest. When you're granted the restricted stock, there's no tax impact unless you're doing RSUs and an 83B election is made. You have to decide if it makes sense to do an 83B, and I'll talk about 83B on the next slide. You need to make sure you understand the vesting schedule. What's happening today is, once upon a time, usually restricted stock vested at the end of each year, after it reached a full year. Now, restricted stock and restricted stock awards are vesting monthly, quarterly, and yearly. And when you have a mixture of all of those, it's very difficult to keep track of it. Some companies are doing it, some companies aren't. When you vest, that is when ordinary income tax and FICA are due on the vesting of the batch of restricted stock that is vesting at that time. You have to pay the tax. Excuse me. You have to decide when to sell the stock. How much concentration risk are you going to be comfortable with? Some people have most of their wealth held in their company stock, which means if something happens with that company, they're in bad shape. And that's happened many, many times through the years. I know we all think our company can't have that happen to them, but it does happen. You want to have a rules-based approach to selling. What does that mean? You lay out, this is when I'm going to sell, how much it's going to be worth, et cetera, and price when you sell. When you sell, tax basis is based on the fair market value of the stock at vesting. And if you don't sell on the day of vesting, you're either going to have short-term or long-term capital gains treatment. And it could be gains or losses, depending on what's happening with the stock. But the major issue that I've seen many times in this situation is if the employee is subject to a blackout period and it happens at the wrong time, I've seen people lose 20, 30, 40, and 50% of their wealth because they couldn't sell during this blackout period. Now, that's usually reserved for senior level executives, but it can happen with however the rules are laid out with your company. You could be a key, you may not be a senior executive, but you could be a key technical person and with privy to what's happening with the product that you folks have. And guess what? You could be in a blackout period and things could be going bad with the stock and you can't do anything about it. An 83B election is a critical tax filing option related to restricted stock awards. An 83B, when you have an 83B, you can pay the taxes within 30 days of the grant. If you do that, basically what you're betting on is that the stock will be worth a lot more in the future. So you're paying the taxes on a much lower base. Now, when you do that and it's worth a lot more, you're in great shape. But it could be the stock goes down. And if you do that and the stock goes down, you do not get back your overpayment of taxes. But most of the time, I would say people that elect to utilize the 83B, but again, this is only for restricted stock awards, not restricted stock units, it works out. Okay? All right. And again, taxes are paid at the when the grant is issued or within 30 days. And potentially, you're locking in much lower rates. Key things to take into consideration when you're looking at RSUs and RSAs. You're going to earn money because it's going to be worth something. Okay, it's likely not going to go to zero. And you didn't pay anything for it. So you're going to make money. The question is, how much money? Vesting means earning ownership over time, graded or all at once. Some things you get, they are vested each year or each month or each quarter. And some are at the end of 3 years, all at once, at the end of 3, 4, or 5 years. But it's going to be worth something. At grant, no taxes are due unless you have elected an 83B. Fair market value of stock is ordinary income. Tax is you pay that on the vesting of that stock. Capital gains or loss if the stock is held. And the way it's computed is very simple. Whatever the price of the stock is when you sell it, let's say it's $50, but the tax basis when you vest it was $20, you have $30 in gain. That is how capital gains, short or long term, is going to be calculated. You really got to know the plan rules. You really got to know the vesting schedule. And when you got multiple different vesting schedules, you got to figure out how do they all come together. When do you exercise the ones that are monthly versus quarterly versus the ones that are annual? Taxes are due when the restricted stock vests, and it can really increase your taxable base certain years depending on how things frack out as far as all the things that could happen when you have these multiple different vesting schedules. Once vested, a decision has to be made whether you hold or sell the stock. If you sell on the day it vests, you don't pay anything additional other than what you paid at the time they vested. If you hold in short term, less than 12 months, you're going to pay short-term capital gains. Over 12 months, you're going to pay long-term capital gains. Taxes and RSUs. No tax when you're granted, when the RSUs are granted. When they vest, the stock value becomes ordinary income. When you sell, you pay taxes based on how much the stock value has changed. Okay? So when you sell, you pay taxes based on how much the stock value has changed. Again, the previous example, vested at $20, sold at $50, you got $30 in profit per share. Voting rights, RSUs. No voting rights until vested. Graded vesting schedule, no dividend rights. Shares are not issued until you are vested in those shares. No 83B election available. It's ordinary income tax and FICA upon vesting. You got to pay for those. Normally, if it's under $1 million, they're going to withhold enough shares for 22%. If it's over $1 million, they're going to withhold enough shares for 37%. So if you got 100 shares, 22% of 100 shares is 22. That leaves you with 78. Tax basis, again, I'm going to repeat myself, fair market value of shares at vest. And it's on your W-2. When anything on your W-2 is ordinary income tax. Now, RSAs, what's the difference? These are 2 or 3 main differences between RSUs and RSAs. Delivery of the shares in RSAs are held in escrow. You have the voting rights for them, you have the dividend rights. Shares are issued at grant, but held in an escrow, so you can't sell them, but they're yours, kinda. If you elect the 83B, you got to do it within 30 days of the grant. Again, as far as the default withholding rates are the same for the RSAs as they are for the RSUs. Now, different companies have different ways of paying for when the shares vest, but most of the time it's withholding of some of the shares that vest. And again, it's on your W-2. Now, an RSU timeline. You got the grant and the vesting period. It could be 1 year, 1 month, 1 quarter, etc. Now, once they vest, grant, vest, when that happens, you have the tax basis. Once they vest, that's what, on that day they vest, that whatever the shares were selling at, that is your tax basis, fair market value at vest. If in fact you sell right then that day, you're only going to pay the ordinary income tax and FICA that's due. If you hold on to them, you still pay that, but later on, if it's 3 months later, 8 months later, less than a year, you're going to pay the difference between what the stock is selling for now and what it was selling for when it vested, and you're going to pay ordinary income tax on that. If you wait over a year and you sell them and there's a gain, you're going to pay the difference between that gain and the fair market value, but you're going to pay at long-term capital gain rates, which could be 15 to or 20% more than likely. Most times 15%, sometimes 20%, depending on the level of income. But you also could have a loss because you waited. You're in a way, you're kind of gambling, but you hopefully know enough that nothing bad is going to happen in the next year. But now when you start holdings, a lot of these shares over a long period of time, it becomes trickier because of the buildup in the stock and the holdings and how much you're going to have to pay. Even though it's capital gains, it still can add up to a lot of money. You got to make smart decisions. Should you sell the stock right away or hold it? Think about how much risk you're okay with. Check if there are any rules stopping you from selling, like blackout periods. Blackout periods are mainly for senior level executives, but they could be for key technical people also. Why is that bad? Because if the market happens to be going down in that blackout period, you're stuck. You can't do anything. So I've seen people go from 20 million to 10 million in certain blackout periods. And that's heartbreaking. You got to plan. Failure to plan is planning to fail. Know when your RSUs vest. Keep track of stock details and planning tools. Follow a clear plan for selling or holding. Either one, you got to have a plan. Imagine you're giving 300 RSUs, and at the year one, 100 shares vest at $20 each. At the year two, 100 shares vest at $30 each. At the year three, 100 shares vest at $10 each. At the end of year one, the first 100 shares vested at $20, and that's 20 times 100 is $2,000. You're going to withhold 22%, which is 22 shares. That leaves you with 78 shares. 78 shares times $20 is $1,560. That are your net proceeds because they were sold the day of vesting. So that's all they paid in taxes, was what's up front, which is the taxes withheld. In year two, you got 100 shares that are vesting again at the end of year two. The stock is trading at $30, so it's up $10 a share. So you got $30 times 100 shares, $3,000. Again, 22% of the shares are going to be withheld. So you got 78 shares that are delivered to you. Now, 22 at 2 years from now, when the person is ready to sell, and the stock is up to $50 versus the $30 when invested, that's $3,900 for sales proceeds, 50 times 78 shares. Now, if you do the division, remember, the shares $50 current price minus what the vesting price was, $30, that's $20 gain per share. So $20 times 78 is $1,560 gain, long-term capital gain that happened at the end of year two when the person sold. What does that mean? That means they're going to get taxed on that $1,560 at a pretty low rate, either 15% or 20%. Most people are in the 30+% tax bracket when they're at these kinds of levels. So 15 or 20%, quite frankly, is great. At the end of year three, though, the stock has went down. It's trading at $10 a share. So $10 a share times 100 shares is $1,000. Still 22% of the shares are going to be withheld for taxes, leaves you with 78 still, which is $10 a share times 78, only $780. But they're not selling right now, so there's no tax impact. The tax impact is only when you sell, when you do something with them. Your decision matters. You can sell right away, pay the taxes, avoid the risk. You can hold, risk stock value going up or down. You can plan, decide based on your goals and comfort level. Which do you think is better for you? Planning and deciding based on your goals and comfort level versus selling right away or holding and risk the value going up or down, or planning and basing it on a plan. Quite frankly, most people work pretty hard to earn their restricted stock units. Back in the day, sometimes we'd be working 12 and 16 hours a day in the corporate world. And I know many of my corporate executives are doing that today. They don't even know what their home looks like. By the time they get home, they just crawl into bed, fall asleep, and crawl out of bed when that alarm clock hits the next morning. But the question is, are you doing things to truly maximizing their value? because you have to put it all together. You have to have a strategy for the restricted stock units or restricted stock awards. You have to have distribution planning. You have to have tax planning. Tax planning is so important. Most people go and see their tax accountant at the beginning of tax season. They take this folder with all of their receipts, et cetera, go in, give them to the accountant. They put them in a program, spell it out. They tell you how much you owe or how much you're getting back if you overpaid during the year. But the question becomes, with tax planning, you want to do tax planning as early in life as possible, in retirement, and in your later years, right? We've seen people who could have ended up with $5 or $6 million end up with $10 million because of tax planning, and the same in reverse. Because they didn't have tax planning, they ended up with a lot less. Without the right plan, taxes and market volatility and poor timing can drain away any wealth you built. Now, Ed Slott, I don't know how many people know who Ed Slott is. He's considered the #1 guru in America when it comes to taxes. If you listen to NBC, CNBC, and Wall Street Journal and Kippinger's and whatever, but he would say, you have a choice. You can have your plan, and if you don't have a plan, guess what? Uncle Sam and the IRS has a plan for you. So you have to decide, do you want your plan or do you want Uncle Sam's and the IRS plan? Think about it. Are you confident you're not overpaying when it comes to taxes? Do you have a clear plan for when to liquidate the shares? Are you balancing your RSUs within your overall financial goals? Are you really looking at it as one? Because that's key. You can't just look at it in silos. Don't wait until it's too late. Every day without a strategy means you could be leaving, depending on how big your awards are. It just depends. If they're not big, then you're talking thousands. If they're big and you're a senior level exec, you're talking millions on the table. Why risk financial security when you can take control? Again, this is a moment to act. As an Slott Master Elite Advisor, I have extensive experience with tax planning, income distribution, and RSUs. Based on my background in the corporate world, I've experienced all of those things. So it's not just me looking at it from being a financial advisor, but also my own experience. So I have my own experience and the experience of being a financial advisor. And I've been doing this for over 20 years. Anthony has put a link in the chat box for you to reserve an appointment with me. And I would urge you to do that. Worst case, you're going to get some ideas on how to do things better than what you're now doing.